Hello, welcome from Trend Signal for a review of the data and events the week beginning the 12th of August. Glorious 12th, not if you're a grouse, of course. Inglorious, as some people have called it. Anyway, we're in the middle of the summer, although you wouldn't realise it with the weather that we're all having. But anyway, onwards we plod. Central banks continue to follow the US lead in cutting interest rates. Last week, the Reserve Bank of New Zealand surprised us all by cutting their key interest rates by 0.5% to 1%, as opposed to 0.25%. Other central banks have also recently cut, on top of obviously the Federal Reserve and Reserve Bank of New Zealand, Brazil, India, Thailand, Philippines. So Trump, while many feel that the US and Trump are justified in pursuing China, this has caused or accelerated a global slowdown in economic activity that is resulting in these responses from central banks, largely. That's the reason. Part of the reason for the recent slowdown and poor GDP data, gross domestic product data, in various countries is down to this US-China trade war. Even the poor UK GDP data released last Friday, whilst it's the worst number since, God, was it 2012, 6 years ago. It's not just Brexit related, as the EU and economies further afield slow down. Sure, Brexit has had an impact, causing, I think, certainly the car industry that brought forward its sort of summer shutdown or the retooling to prepare for new models, etc. That had some effect, and that will be reversed in Q3. Markets are generally in recovery mode. Just quickly flicking to let's have a quick look at the S&P. We can see here the S&P following the significant fall this time last week on Monday when the yuan fell through the 7 level versus the dollar. The markets just had a bit of a fit set in the forest that spread really globally, hence this massive candle on the US markets. But it's been in recovery mode since then, which is not surprisingly. Bond yields are just plumbing negative depths all over the place. It really is. There is, as someone said, Tina, there is no alternative to equities with the yields on bonds, just making it certainly totally unattractive, certainly for retail investors anyway. So let's get on to the data and events this week, which is the reason for this. Bank holiday in Japan, so obviously no action there, as I talked to you on Monday morning. Hong Kong is still reeling from the protests about this extradition bill that seems to have morphed now into a more widespread sort of pro-democracy movement. But even in Hong Kong, the Hang Seng's managed to eke out a small gain. Other markets quite steady across the board, which has resulted in a positive moves Monday morning for now anyway. Data, we've got average hourly earnings out in the UK on Tuesday, so nothing much on Monday. Tuesday, average hourly earnings, another bounce, so wages well ahead of inflation, which will please the government. If it gets too much, obviously it can be inflationary, but I think we're not in that time period just yet. German ZEW economic sentiment indicator. This is something that has been downgraded to a medium impact number, certainly by Forex Factory. But clearly sentiment is very poor in Germany and expected to get worse. So predicting a negative 27.8 reading, having been 24.5 last month. US CPI data, inflation data, we look at the core CPI data, or lack of it, really, plus 0.2%. So not enough to worry the Federal Reserve or the FMC or the markets for that matter. So fairly benign there. We jump to Wednesday, and China industrial production is the first sort of number we'll be looking at, whilst the actual number, no one knows whether the Chinese state published what we want to read or what is actually happening. We don't think those numbers are quite that strong, but whether it's coming from an independent source, the Chinese state, the fact is it's indicative of a slowdown in China, 6.3 now, 6% expected in industrial production. Inflation data here in the UK. UK CPI, year-on-year inflation data, slight slip to 1.9% is expected, pretty much at the Bank of England target of 2%. No risk of any movement on rates, of course, because we're in this pre-Brexit, no deal possible outcome on the 31st of October, but something will happen afterwards for sure. Something I also want to look at, the German GDP data for Q2, their prelim reading, minus 0.1%. I'm surprised it was as strong as it was the previous quarter, but minus 0.1%. A lot of data coming out of Germany is really quite negative. I don't know. Data could even surpass this quite bearish expectation. So it's not just the UK, it's not just Italy. German economy, the largest in the Eurozone, certainly struggling. So we'll find out on Wednesday about that. Thursday, it's Assumption Day across Europe. Most countries celebrate this day. I don't think all the markets are shut, though, so just be careful which ones are open and closed. US core retail sales used to be quite important. Isn't it strange how some get labelled high impact while others are not, and that's not my reading of their sort of relative merits, as it were. Anyway, plus 0.4%, our core retail sales coming in line exactly with last month's retail sales. Philly Fed Manufacturing Index, something that is not always talked about, but the Federal Reserve is split into districts, and the Philadelphia region has a large concentration of manufacturing. So this is followed quite closely as a sort of a bellwether for manufacturing activity in the US. So a fall from 21.8 to 10.1. That's quite a fall, actually. I'm not sure the reason for that. China-US trade war, maybe. I'm sure. Friday, no significant data, although we do have the prelim University of Michigan consumer sentiment number. Consumers are happy. They spend more money. It's a leading indicator. It'll tell us what will happen in the future, and that's the idea anyway. Little pullback, but nothing too much to worry about from 98.4 to 97.2. And of course, Brexit is going to continue to dominate our own sterling markets. Parliament's in recess, but the media and politicians aren't, as they continue to guess what course of events will take place in September when Parliament sits again. It's anyone's guess, of course, but it does seem possible now that Brexit will happen or could happen even with a successful no confidence vote. So expect sterling markets to be even more choppy and even more unpredictable. That's it. Thank you very much for listening. All the best. Bye for now.
If you would like more information about trading the right way, Trend Signal is giving you the opportunity to see and hear about its services live at a free online seminar. Take a look at the Trend Signal website for the latest events and to book your free place.